Welcome to the world of cryptocurrency investing. If you've already dipped your toes in with Bitcoin or Ethereum and are wondering, what's next? This guide is for you. We'll explore a simple yet effective framework for diversifying your crypto holdings while managing risk in this exciting but volatile market. Congratulations on taking the first step into cryptocurrency. But now you're faced with a daunting question: what's next? The cryptocurrency universe has exploded to include over 20,000 different tokens and projects. This overwhelming number of options presents both opportunity and risk for investors. Common questions you might be asking include whether to stick with Bitcoin, how to avoid scams, and which projects to invest in. Without a framework, navigating this complex landscape can lead to poor investment decisions driven by FOMO rather than strategy. For those looking to build their first serious crypto portfolio, the 70-20-10 rule provides a straightforward allocation strategy that balances opportunity with risk management. This rule suggests allocating 70% to established cryptocurrencies like Bitcoin and Ethereum, 20% to large-cap altcoins with growth potential, and 10% to smaller-cap coins with speculative potential. This framework allows you to participate in the potential upside of various cryptocurrency segments while keeping most of your investment in more established assets. The foundation of any crypto portfolio should be Bitcoin and Ethereum. These blue-chip cryptocurrencies have several key advantages, including a large user base, developer communities, and market liquidity, making them more resilient to market downturns. Major financial institutions, corporations, and investment funds have embraced these assets, providing stability and legitimacy. They also offer regulatory clarity, which is essential for investors seeking a safer investment environment. Bitcoin, often called digital gold, was the first cryptocurrency and remains the largest by market capitalization. Its key features include a fixed supply, high security, and simplicity in its mining network. Ethereum, described as programmable money, is a global computing platform that enables smart contracts and decentralized applications. It supports a wide range of projects, including NFTs and DeFi, and is crucial for the emerging Web3 ecosystem. Your allocation between BTC and ETH depends on your outlook and risk tolerance. The contenders allocation should go to established alternative cryptocurrencies with significant market caps, active development, and unique value propositions. These contenders represent higher risk but also higher potential reward than Bitcoin and Ethereum. Examples include Solana, Cardano, Polkadot, Avalanche, and Chainlink. It's generally advisable to limit your contenders selection to 2-4 projects that you understand well. The final 10% of your portfolio is where you can explore higher risk, higher reward opportunities. This allocation should be viewed as speculative money you can afford to lose entirely in exchange for potential outsized returns. This category might include small-cap altcoins, new narrative-driven sectors, and tokens from emerging blockchain ecosystems. The 10% allocation ensures that even complete failures in this category won't significantly impact your overall portfolio, while still allowing you to participate in potentially transformative projects early in their development. When researching your 20% and 10% allocations, consider the utility of the project, the team behind it, and how value is captured. Evaluate whether the project addresses a real-world problem, the experience and transparency of the team, and the economic model of the token. Be skeptical of projects that don't have a clear use case or are based on speculation. Additional research criteria include development activity, community engagement, competitive analysis, and risk factors. Check for regular code updates, active community discussions, and a clear project roadmap. Understand the competitive landscape and identify potential challenges such as regulatory concerns or security vulnerabilities. This thorough research will help you make informed decisions and manage risks effectively. For comprehensive cryptocurrency research, utilize resources like CoinMarketCap and CoinGecko for market data, DeFi Llama for decentralized finance metrics, and Messari for research reports. Technical analysis can be deepened through white papers, GitHub repositories, and developer activity. Community insights can be gained from Discord and Telegram channels, crypto Twitter, and Reddit communities. These resources will provide a well-rounded understanding of the crypto landscape. This sample allocation demonstrates how to implement the 70-20-10 rule with a $1,000 investment. The majority goes to BTC and ETH, with smaller portions allocated to contenders and high-risk plays. Remember that this is just a starting point. Your allocations should reflect your own research and risk tolerance. The specific contenders and high-risk plays you select should be based on thorough research tailored to your investment goals. Over time, your portfolio allocations will naturally drift from your target percentages as different assets perform differently. Rebalancing is the process of periodically adjusting your holdings to maintain your desired allocation strategy. This can be done quarterly, semi-annually, or annually, depending on your preference. Rebalancing helps maintain your risk management strategy and can prevent impulsive reactions by systematically selling high and buying low. To rebalance your portfolio, calculate the current value of each asset and compare it to your target allocations. Make trades to buy underweight assets and sell overweight ones to align with your target percentages. Consider tax implications, as frequent rebalancing can trigger taxable events. For smaller portfolios, a semi-annual rebalancing schedule may be more practical to keep transaction costs in mind. Avoid common mistakes such as overcomplicating your portfolio, making emotional decisions, chasing past performance, neglecting security, and failing to plan for taxes. Stick to a manageable number of assets, make decisions based on strategy rather than emotion, and ensure your crypto assets are stored securely. Planning for tax obligations is crucial to avoid unexpected financial burdens during tax season. While the 70-20-10 rule provides a solid foundation for beginners, there are legitimate reasons to adjust your strategy over time. Increased knowledge, changing market conditions, evolving financial goals, and technological advancements may all prompt you to reassess your allocations. Stay informed and be ready to adapt your strategy as your understanding and the market evolve. With more experience in the cryptocurrency market, you might consider these more advanced strategies: dollar cost averaging to reduce the impact of volatility, staking and yield farming for additional income, and sector-based investments in blockchain sectors like Layer 1 protocols and NFTs. Remember that more complex strategies typically require more time, knowledge, and active management. Exiting your portfolio is important. Having an exit strategy is equally crucial. Many crypto investors focus exclusively on accumulation without planning for when to sell their gains. Consider 3 exit strategies: percentage-based selling, dollar cost averaging out, and take initial investment out. These strategies can help you make informed decisions during market upswings and prevent the common scenario of watching significant gains evaporate during market corrections. Risk management goes beyond allocation. Secure storage with hardware wallets, mental preparation for volatility, and meticulous record keeping are essential. Stay informed about project developments and use reputable exchanges with strong security features. Consider your investment time horizon, as shorter time frames generally require more conservative allocations focused on established assets. This presentation provides educational content only and should not be considered financial advice. The 70-20-10 rule is a general framework, not a specific recommendation for your individual situation. Always conduct your own research before making any investment decisions. Cryptocurrency investments are highly volatile and speculative, and tax implications may vary in your jurisdiction. Consult with a qualified tax professional to understand your obligations. This guide provides a structured approach to building your first cryptocurrency portfolio, allowing you to establish a strong foundation with proven assets, explore promising alternatives, and participate in potentially revolutionary projects. Remember that this framework is just a starting point. As you gain knowledge and experience, you'll develop your own approach based on your unique goals, risk tolerance, and market insights. What does your crypto portfolio look like? Are you following a specific allocation strategy? Share your thoughts and experiences as you apply these principles to your own investment journey.